We're going to talk about the organization of the FX market. First of all, what is the FX market? You may want to find a way to exchange foreign currency into your own currency or vice versa. Let's say you are a UK investor trying to buy US stock. First step you need to do is to convert pound into dollar. Then you can invest into US stock market. These exchanges of foreign currency for own currency occur in FX market. Now, traditionally, the FX market is an over-the-counter market, which means the trading does not take place in a central marketplace where buyers and sellers meet. So there's no central place like a stock exchange. We don't have that. The FX market is a worldwide linkage of currency traders and dealers connected via a network of telephone, computer terminals, and automated dealing system. Let's take a look at BH Baker-Hardwick Exhibit 2.1. First of all, you can notice this one here, the major banks interbank market. Traditionally, this was the biggest FX market. And as a customer, you are here. And if you want to exchange foreign currency for your own currency or vice versa, you could go to local dealers or smaller banks, or nowadays you can do that by online. We'll talk more about this one later. So just notice now there is a big major market between banks here, and as a customer you're gonna use one of these routes to exchange foreign currency into your own currency or vice versa. The FX market is the largest financial market in the world. So BIS says that in 2013, in terms of trading volumes, every day there was a $5.3 trillion trading in FX market in April 2013. You can compare this number to $36 billion in New York Stock Exchange. So FX market is huge. What is BIS, by the way? BIS is the Bank for International Settlement. It's an international financial institution owned by 60 central banks. It fosters international monetary and financial corporations and serve as a bank for central banks. So bank of the central banks. And they try to maintain global financial stability. Anyway, now FX market operate 24 hours per day. So first start with the Asia and then Europe and finally North America. So you can trade FX anytime you want. And most important city would be London and New York and Tokyo. BH Exhibit 2.2 gives you the foreign exchange trading activity across the world. So comparing 1995, 2004, 2013 in billions dollars. As you can see in 2013, UK, the London, has a 40% share in FX trading. And then US is the next, 20%. Most important city is New York in US. So London in UK, New York in US, and Tokyo and Singapore, etc., etc. I want to give you some updated number on the importance of FX market and other things. In April 2022, BIS coordinate the Triennial Central Bank Survey and providing the most comprehensive and internationally consistent information on the size and structure of global OTC over-the-counter trading in FX and other derivatives. Specifically, 52 central banks participated. They collected data from more than 1,200 banks and other dealers. If you click this URL, you can find more information. If you're interested in reading this paper, you can just double-click this icon here. Anyway, the daily trading volume is $7.5 trillion. So it was $5.3 trillion in 2013. Now, London is the world's largest foreign exchange trading centers. The daily trading volume in the UK is the 38% of the $7.5 trillion. US is the second. 19% of the $7.5 trillion trading activity occurs in US. Now I want to talk about the type of contract we can use in FX market. First of all, we have spot market. Here, spot refers to the market for immediate exchanges of currencies. In real practice, when the FX trade involves the US dollar, so you want to change US dollar for pound, the spot contracts are normally settled in 2 business days. So you make a contract today, after 2 business days, you're going to get the foreign currency. So you can take a look at Baker Hardwick chapter 2 page 50 for some exceptions. For some FX trade, you need more times, even in spot transactions. We also have a future transactions. Here, future transaction means you are making a contract today, but the actual exchange of money will happen in the future. We're going to talk about 2 different forms of contracts. First one is the outright forward contracts, and next one is the FX swaps. I just want to make a note here. FX swap is the combinations of spot and forward. We're going to talk about these using example later on. And there are also other instruments, derivatives, FX futures, options, and so-called currency swap. We're not going to talk that much about these topics. These will be taught in semester 2. So anyway, if you are interested, you can take a look at Baker Hardwick PH chapter 20 and 21. In terms of trading activity, trading volume, BIS 2022 report 51% of the total FX trading activity, $7.5 trillion. 51% is FX swap. So FX swap is the biggest trading form of FX. And next one is the spot transactions and outright forward transactions. Let's take a look at foreign exchange market turnover trading activity by instrument across different period. So here 98 means 1998, 01 means 2001 to 2022. And the yellow one is the FX swap. So as you can see, among $7.5 trillion, approximately 51% of total FX trading activity is FX swap. And as you can see from here, FX swap trading activity has been dominant for all period. And also you can notice that in 1998, the total trading activity is around $1.5 trillion. In 2022, it became $7.5 trillion. Huge growth for about 20 years. By the way, what are the top 5 traded currencies? US dollar dominate. US dollar was involved in nearly 90% of the total global FX trading activity. This dominance is evidence across all FX instruments, spot, forward, swap, and futures and options. At least 85% of trading in the spot and others involves with US dollar. So what are the top 5 traded currencies? US dollar, Euro, Japanese yen, British pound, now Chinese yuan. In this slide, I have attached 2 YouTube video clips explaining the summary statistic of 2019 trial bank survey and 2022 trial bank survey. If you are interested, please take a look at these video clips. You will get many interesting facts about FX trading activity by looking at these video clips. Now we want to talk about the major participant in the FX market. First of all, I'm going to talk about the FX dealers. The major participants in the FX market are the commercial banks and investment firms. And they function as dealers. They are making a market in several currencies. What is the meaning of making a market? The market makers or dealers, they are ready to buy and sell the currencies with retail customers like you or other market participants. What is the meaning of that is they quote price at which they are willing to buy, so-called bid price, and they quote also ask price to their customers. And by presenting these 2 prices, they can get bid-ask spread as there's a compensations for providing this stand-ready service. And also we can say that they are providing liquidity to the market. So what is the meaning of liquidity in this context? Dealers make it easier and less costly to match buyer and sellers. So the liquidity means if you want to buy or sell foreign currency, you can just go to the market. Always there are some dealers trying to make a deal with you. But they need some compensations for their trading activity. That's the bid-ask spread. I will provide more information later on. BH Exhibit 2.3 gives you the list of the top 20 FX dealers in FX market. So the number one dealer is the Citigroup in 2015. Number two is the Deutsche Bank's, well-known commercial banks, right? There are other important participants in FX market. So customers. The first customer we can talk about is the leveraged financial institutions. So for example, hedge funds specialized in various currency investment strategies or high frequency trading. So here leveraged means their debt ratio is like a 1000%. So they have, for example, $10 million as their capital. Then they borrow like a $100 million from some banks, and based on this seed money they do various investment, right? So hedge fund is a leveraged financial institutions. And also we have many non-financial customers in FX market. So multinational companies using FX market to acquire currencies for trading purpose. And central banks are also important participants, and they often defend their own currency by buying and selling foreign currency. There are also some unleveraged financial institutions like a pension fund. So they invest into FX market to hedge or investment. And also retail investors. So you can visit this place to see and what they are trying to do in FX market. There are participants called brokers. And what they do is they just match buyer and sellers, but they do not put their own money at risk. This is the difference between dealers and brokers. Dealers use their own money and they quote the different price, bid and ask price, and they make money from bid ask spread. Now brokers, they just got the small brokerage fee. They don't get any bid ask spread. They just match buyer and sellers. Back to BH Exhibit 2.1. We have inter-dealer market here. So major commercial banks and invest firms participate in this market and they trade against each other. So inter-dealer market, inter-dealer market. And we have online trading system here. And large company, large multinational company or institutional investor, they participate, and we have FX brokers. Now in this major market, we have spot market, we have forward market, and FX swap. And as a customer, retail customer, you can exchange foreign currency against these small banks here. They go to major interbank market and they trade with the dealers in this market. Nowadays, customers can directly go to online trading system to trade foreign currency. And here, this is the FX based options and futures. These are traded in organized exchange, like a Chicago Mercantile Exchange. Historically, the FX is a two-tier market structure. In tier 1, there is a trading between retail customer and other customer versus dealers, small dealers or large dealers. And in tier 2, there is a trading between dealers. It's called inter-dealer market. And often the FX trading is intermediated by brokers with some small brokerage fee. However, nowadays, because of the multi-bank trading system and FX prime brokerage structure, allow any customers to trade directly with dealers in inter-dealer market. So if you are interested what these are, just visit this website for more information. So traditionally, we have tier 2 market here, and other than this one, we have tier 1 market. There's no central marketplace. Everything is connected by some kind of communication system. Nowadays, because of online trading and others, we have bigger trading activity happening in this venue. I would like to emphasize the recent electronic trading revolutions. So we can observe this rapid growth in algorithmic algo trading and high frequency trading in FX market for the last 10 years. It's a 2014 paper. This paper is posted on Blackboard. If you're interested, you can take a look at this paper. Why we saw the rapid growth in algo trading? Hedge fund used to be the end customers trading FX with the dealers in interdealer market. Now they can access the FX market directly via electronic trading system. Now they even start behaving as a market makers, dealers in this market. And what is the algo trading? Algorithmic trading means you write a computer code implementing tradings. So once you get some signal, you buy. Once you get different signal, you sell. You write a code doing it, and human doesn't touch this program during the trading activity. This machine making its own trading decisions, sometimes investing, sometimes being as a dealers. This algo trading rapidly expanded. In the next slide, we're gonna see the fractions of total volume where one of the counterparties in FX trading is an algorithmic trader. It's from this paper. So for dollar and euro trading, and for yen versus dollar trading, and for yen versus euro trading, we see, for example, for the FX trading, even in 2008, almost 80% of FX trading activity involves algorithm as one of the counterparties. This paper called this as the rise of the machines. So algorithmic trading is one of the most important participants nowadays in FX market, as an investor and as a dealers.